Chapter 9 Budgeting. Again, the course is Introduction to Managerial Accounting. Today we're going to go to one of the main activities that every manager has to do in the first stage of the management cycle, which was the planning stage. And that is to prepare the budget. Now, the question is, what is budget? Budget is a detailed quantitative plan for acquiring, as you can see, and using resources, which are financial and other resources, for a specific forthcoming time period. So again, budget is detailed quantitative plan for from where you're gonna get and how we're gonna use any resources, financial and non-financial, over the specified forthcoming period or future period. The act of preparing the budget is called budgeting. And when we're using the budget as control for the organization activities, no source of budgetary control. Why do we need the budget? Obviously, we need the budget for one specific reason, and that's because we have a plan. We have a goal. If we have a goal, we have a plan. If we have a plan, we have alternative, how we're gonna achieve our goal. And next step is to prepare the budget, because the budget is gonna give us step-by-step quantitative plan of from where we're gonna get and how we're gonna use the financial resources for the forthcoming period for only one purpose, to achieve our goal. Now we're going to use, once we prepare the budget, we're going to use it for control purposes. First, we're going to use it for planning purposes, where we're going to involve developing objectives and preparing the various budgets to achieve different objectives. For every objective that you have, you're going to prepare different budget. You already know that, I don't have to tell you. I'm going to put it in some terms which are a little bit more academic terms, if I can put it that way. You perfectly know that if you want to cook a specific dinner, you have one plan. If you want to go and eat outside, you're going to have different plan. Each plan have a different objectives. So what you have to do now, first you have to get, if you want to cook a dinner, what you're going to see, quantitative plan of from where you're going to acquire specific items, how many of those, in order to get the final result, which is the dish, which you can eat. If you don't have the ingredients that you need, you're not going to prepare the dish. Obviously, before that, you have to have a different budget, which is going to be the cash budget, from where you're going to get the cash and how you're going to spend the cash. But after you have that one, then when you want to eat, you're not going to eat cash, right? So now you have to use the cash to get some other items, which are not financial items, resources, in order to achieve your objective, which is to have a meal for dinner. We're going to use the budget for the control purposes, which will be involve the step that manager can take to attempt to ensure the objectives are achieved. Again, don't forget, we open the company because we have specific objectives. Those objectives, generally can say those objectives are related to profit. Now, in order to generate that profit, we have to have a different objective in order how we're going to attract the customer, what kind of product we're going to sell to the customer, how we're going to sell that product to the customer, how we're going to increase the sales, what kind of different activities we're going to do. But we have to have a plan. And once we start going over the plan and the time comes and we start to execute the plan, we're going to use the budget to tell us every time where we're supposed to be within our plan. Which advantages if we have a budget? The advantages is, first, we can clearly define the goal and objective, and we can communicate that goal and objective with everybody in the organization or everybody in your household. Once everybody knows the goal and objective, then we can coordinate the activity which gonna bring us to our goal and objectives. The budget is gonna show us how we're gonna acquire the resources and how we're gonna use the resources. On what kind of means we're gonna allocate those resources. We can communicate using the budget to communicate the plan within the organization or within the family. Now, once you have a budget, obviously you can start thinking about the future. And eventually the budget can review some potential bottlenecks that you may have. What's the bottlenecks? That will be some constraints that you may have. I believe most of you already have a plan how many courses you're gonna take each semester, correct? Do you have a plan? Do you have a schedule? Are you taking, if I take these courses, how many semesters gonna take me to finish the objective that you have in the beginning? Before you come to Douglas College, you have your objective. What will be the objective? Different people are going to have different objective, but you communicate that objective with everybody. First, you communicate it with the school, you communicate it with your significant or people related to your significant one, right? It can be your mother, it can be your father, it can be your relatives. You communicate in that objective. And then you're communicating with your friends. Why? Because if you have to now go and watch the game, you're going to say, no, I'm not going to watch the game because my objective is to get uh, my diploma from Douglas College. And one of the steps to get my diploma is to attend the class. I know I don't like that Ivan sitting on that beach and the wind blowing the whatever he had left on his head, but I still have to stay. Why? Because obviously I want to achieve my goal. What will be your goal? Our first goal is to finish the course. Second goal is to finish the semester. Next goal is to finish the school or the program that you're taking. Next goal is to get the job that you want to get. And after you get the job that you want to get, then there will be another objective and keep going with the objectives, keep going, another goal. When we have a budget, that keeps people responsible because everybody knows what we have to do, what he has to do, how he can help. But one thing that we have to know, we cannot use the budget to punish the people. We can use it to make the people responsible for only for the items that they can actually have control to the significant extent. If they don't have control, we cannot keep them responsible. I cannot keep responsible if I have a coffee shop and if I have a waiter, I cannot keep my waiter responsible. Why do we don't have a clients during the coronavirus time? It doesn't matter what my waiter doing, we're never gonna have a client. Why? Because there's something which is beyond everybody's control. How are we going to use how are we going to prepare the budget? There are different type of budget. The most common budget is 12 months budget. 12 months budget is also called operating budget. One operating budget, as you know, from financial accounting, the short-term assets and short-term liabilities is the one that assets are converted into cash within the 1 year or current operating cycle of the company. And since the current operating cycle of the company most likely will be 12 months, for that reason, we're going to call it budget. When we have 12 months budget, we're going to call it operating budget. Everything above 12 months will be called capital budget. Capital budget is not going to be subject of this course because in the capital budget we have to consider time value of the money. Everything which is above 1 year or beyond 1 year, it has to consider time value of the money. For the 12 months budget, we don't consider time value of the money because, as Statistic Canada says, there's no inflation. Or maybe deflation is very low, so we don't have to worry about it. Now, one of the budget is continuous budget. What means continuous budget? Always going to keep 12 months. Means we're going to prepare a budget from January all the way to December. When the January expire, the January going to drop from the beginning of our calculation. It's going to add it at the end. So now we're going to have new 12 months, which start from February, end up on January 31st. When February expire, that February month drops from the budget and comes at the end. And now we have from March to February. And we keep going, and we're always going to have 12 months budget, which is also called rolling budget. Now we can prepare budget for the quarter. Which will be each quarter will be, obviously every year is going to have 4 quarters. And once quarter is expired, we can add it at the end of the budget. Different way to prepare the budget. One way is we to step up, or you to step up as a manager and say, you know what, I'm the top manager, I'm going to tell you what's going to happen in the company. That's one way to prepare the budget. The other one is to make it participative budget. What means participative budget? Participative budget means that you're going to engage every people in the organization in the preparation of the budget. Why we want to do that? Why we want to involve everybody in the process of the preparation of the budget? Well, there are different advantages for that. First, the individual, all level of organization start seeing themselves as a member of a team, which generally promotes motivation and give the confidence of the people that they heard. Budget estimates, when they're coming from the frontline managers, are more accurate. Usually the people who are involved in day-to-day process, they know what's happened. They can prepare accurate numbers. The people who are distant from that point where action happened, the connection between the company meet the client, the more distant they are, less accurate they are. Obviously, in getting people involved in the process of the preparation of the budget, going to motivate them, make them individual participate in the setting their own goals when the goals are instead of goals to be imposed by somebody above. And the other thing is the manager who's not able to meet the budget which he proposed himself or imposed by himself, it will be hard for that person to come later and excuse himself or herself by saying that the budget was unrealistic. Now, which are the drawbacks? Everything that has a positive has a negative. You have to understand this. It doesn't matter how much you like something, they're always positive and negative. So yes, participative budget looks like a interesting thing. We're going to get everybody involved. Example of participating budget will be, I can use the government, structured government organization to show you the participative budget. Imagine that a Ministry of Education wants to prepare their budget and want to make it participative. So what they're going to do? They're going to go to the classroom and they're going to ask the students, what do you want to see in the classroom? What do you want the classroom to have? Then they're going to ask the teachers, what kind of resources you need in order to be more effective? and in order to deliver the right message to the students, they to understand you, they to perceive it, and to grow in their knowledge in their profession. Once we find out what the customers want and the people who are directly in contact with the customers, then the teacher is going to submit their form to the dean. The dean is going to come get the form from all the teachers in the department. Each department is going to submit the forms to the president of the college or president of the school. But all the colleges, all the schools going to submit their uh, budgets to the school district. All the school districts from the area is going to submit their budgets to the provincial level. And all the provinces going to submit their budgets into that will be, I believe that should be Ontario. And Ontario, when they look at the budget, they're going to say, okay, that's nice number. Thank you very much. But we're going to cut 20%. And then the rest, you have to deal with it. That might be one way to prepare the budget, but at least we get everybody involved, and the number that we have that we need for education is more accurate. Are we going to justify it or not? That's a different story. Now, one thing that we have to be careful, you as a manager who asking the other people to prepare the budget, you have to watch for some things. First thing, one of the things that you have to watch is budgetary slack. What is budgetary slack? Budgetary slack is a number which can be easily achieved, and everything that is done after that number is used from the person who prepared that budget to take a personal benefits. For example, imagine I'm a salesperson on the car dealership. My manager comes and asks me, uh, how many cars you budgeting to sell next year? I perfectly know that in the bad year, I can sell, let's say, 5 cars per month. That makes it 60 cars per year. And in the very good year, I can go double, 120. The way I see the economy, and I can easily predict that maybe it's going to be not a bad year, but some average year. So maybe I should be able to achieve 100 cars, sell 100 cars easily. And when my manager asks me how many cars you're budgeting to sell for the next year, then I'm gonna say 90. Why? Because my bonus is connected to the cars that I'm selling above the budget. And since I know I can easily sell 100, I'm gonna push the number down. I'm gonna say 90. And when I sell 100 cars, which I already participated and I know that I can do that without too much effort, I'm going to go to my manager. You see, I exceeded my budget. Now give me my bonus. That will be on the salesperson. Let's see what's going to happen on the production manager. Production manager, he's usually measured and assessed on the cost savings. So when we ask the production manager, what is the anticipated cost for the coming year, he can easily inflate, in this case, the number. And after that, when he achieves cost savings, he's gonna come to you and say, you see, I am way below the cost which we anticipated in our budget. So I creating cost savings, which turns out to be profit for you. So for that reason, I need my bonus. So be careful with this. Have this in mind every time when you ask people to set their goals. One Interesting thing. This probably is the right place for me to tell you this. From my personal experience. I was when I was start teaching back in 2014. The yes, the second year. This course, Introductory Managerial Accounting. I was teaching this course to the students, and there was this exceptional kid in the classroom, which the kid was doing all the assignments for. Like there were a group of five, knowing each other, and he was doing the assignments, and everybody just writing everything from him, and after that, submitting with the same mistakes. And I approached this kid and I asked him, "Hey, what concentration you are?" And he said, "I'm in IT, information technology." And I said, "Okay, you're doing very well on the accounting. It's like a literally comes natural for you. Why don't you try accounting?" Do you know what he told me? You'll be shocked what he told me. He told me, "Teacher, yes, I know that I'm good in the accounting. Yes, I know that." Probably I'm gonna be very good if I go with accounting. But in IT, I will need 10% of my capacity to pass everything. If I go with accounting, I have to increase that percentage. I don't want to do that. I was shocked, right? So what he's doing is he's literally pushing himself down to achieve what he can achieve with minimal effort when he perfectly know that he has the capacity to achieve everything that he wants. He's just not interested. That was amazing experience. How I deal with the problem with the he sharing the assignments, I'm gonna tell you another time. Let's go with the budget committee. Why do we need the budget committee for? Obviously, they want we to pay them. Now the question is, why do we need them for? Well, those are the one who's gonna assess the overall policy, and they're going to impose that policy in relation to the budget. They're going to coordinate the preparation of the budget, which uh, department, when it has to submit the budget, they're going to be responsible for the deadlines for different stages of the budget. If there's some disputes in relation to the budget, they'll be the one who's going to solve those problems, and they're going to do the final proof for the budget. Successful budgeting depends on three important factors. So, if you want to have healthy environment, regardless in your company or in your family, you, saying you because you're the one who studied to be a manager, that's why you're starting with intermanagerial accounting first, and then you're going to go with the other managerial accounting courses, and eventually you're going to become a manager, which you already are, but you have to be enthusiastic and committed to the budget process. If you are not enthusiastic and if you are not committed to everything that you're doing, nobody's gonna follow your people. I'm sorry. You have to, at some point in your life, you have to step up and you have to understand if you want something to happen, you have to lead the people. And it's okay if you don't feel confident in the beginning or if you don't feel uh, you this is something that you want to do. But if you're not enthusiastic and you're not committed to the process, nothing's gonna happen. One day you're gonna see, maybe you already see it in the environment, the personal environment that you're living. You might come sometimes to the conclusion that if it's not me, everything is gonna fall apart. But that's okay. Then be strong. And be enthusiastic, you be committed. I know it's a hard effort, but keep going. Top manager must not use the budget to pressure the employees or to blame them when something goes wrong. In budget is only to keep you informed where you are and compared to where you're supposed to be. So when you see where you are and compare with the budget where you're supposed to be, you're going to see, is there any differences? If there are differences, in which uh, area the differences are there, something goes wrong or something goes good? Because sometimes something can go wrong and something can goes bad and something can go worse. But we're not going that direction. We're going to the different direction. Something may goes wrong or something may go good. The other thing that you have to do is the highly achievable budget target is usually preferred when the manager are rewarded based on the meeting budget targets. Now, how many of you are parents? Is there any parents here today in the classroom? None of you? Well, let's say one day, I hope every each of you become a parent. And then you have to understand, in order to motivate this young children, you have to be the one who's going to give them motivation. You're the one who have to show them that you're enthusiastic. And you're the one who has to be committed in the process of building that family. The other thing that you're going to see is if you put on unrealistic targets, you're going to discourage the people. But if you go slowly and just put easy target that can be easily achievable, then that drags the people interest and they start asking for more. And when they start asking for more, that's where you're stepping up and start increasing the level of the target. And that's how you're getting everybody involved. And that's how can achieve and can change something in a good way. Probably you're gonna read a lot of books from those people that tell you how to grow rich and how to engage the other people, and even if you read the books from Dale Carnegie, how to make a friends and attract people. Again, personal example is the best. And the personal example is needed when you're preparing the budget, when you're getting everybody involved for one purpose, target to be met, goals to be achieved. So zero budget, that's let's say managers complaining that that's a crazy stuff. Why? Because zero budget every year you start from literally from zero. Whatever happened previous year, you just ignore it. And you start calculation again and again and again. And the manager usually complaining that it's too much time consuming, take a lot of effort to make it again. So why we just not keep the budget from the last year, adjust it to the new reality, and keep going? The best way is to make it a rolling budget, and once month pass, we just add it at the end and keep going. I remember in the socialistic time, there was have the party was sitting and they're doing their budget was 5 years. Every 5 year cycle, they're doing the budget for what's going to happen in the next 5 years. And what they're trying to do is to how can we meet the 5 year targets in 4 years? And when they do that, there's a lot of bonuses which are given to the people who achieve that phenomenal goal, and they were so proud that everything goes well because we achieve a 5 year target in 4 years. Maybe If they can try, they maybe even go for 3.5. I don't know if that's possible, but that was the before. So let's go with the budget and let's start doing the budget. We have a master budget. A master budget is all the budgets in one place. That's what you have to do on your case. You have to prepare a master budget. Now, as you can see, and as you remember from the definition of the budget, budget is a quantitative plan of how we're going to acquire financial and non-financial resources, and then how can we use those financial and non-financial resources. And that's clearly shows why first we have to acquire, because master budget starts with the sales budget. You have to understand, it will be very hard, pretty much impossible to spend or to use resources which you don't have. So it's always, you have to acquire first the resources and then to think, how can I use them? So that's why the master budget always starts with sales. Once we start with the sales, once we anticipate what our sales going to be, who will be identify who client is, how much will be the selling price, how much we expect to sell based on the clients that we're targeting, then we can start everything else. Then we can start doing the ending inventory budget. That's going to help us to make a production budget. And as you can see, once we're producing the items, we are on manufacturing company, and we know that the product cost is direct material, direct labor, and manufacturing overhead. So now we have to produce a production budget for the direct material, direct production budget for the direct labor, and budget for the manufacturing overhead. Once we combine all those, then we're going to prepare the budget for the period cost. Those are all the product costs. Now we're going to prepare the budget for the period cost, which is sales administrative expenses. Once we combine them together, we can prepare the cash flow budget, income statement, and balance sheet. So let's start our adventure and walk through your case that you have to do. Whatever you're seeing on those slides, that's exactly one-to-one what you have to do as a group on your case. And first, we're going to start with the sales budget. And the sales budget, we need some information. Which information is going to be given to you? As you can see here, this company preparing the budget for the quarter ending June 30th. One thing I want to make it clear. Year has 4 quarters. First quarter start January 1st, finish March 31st. Next quarter start April 1st, finish June 30th. Third quarter start July 1st, finish September 30th. Fourth quarter start October 1st, finish December 31st, and keep going. Beginning balance at first quarter is the beginning balance of the first quarter is the ending balance from the previous year. So that means the ending balance of the first quarter will be the beginning balance of the second quarter. Now that brings us to the point, how distant is one quarter to another quarter? Seems like the distance is 3 months, but totally not. It's 1 second. Why is 1 second? Because the first quarter finished on March 31st, 11:59. When the second quarter starts, 1 second later, on April 1st, 00000, midnight. That's where the second quarter starts. So for that reason, the ending balance of the first quarter is the beginning balance for the second quarter. Make sense? Tell me if this makes sense. Can you guys hear me? Okay, you saw thumbs up, that's good. So now let's get this information and move to the Excel spreadsheet. Not this one, I need this information here. Can you guys hear me? Okay, so what we have, again, the same information here. We have this company which we have to prepare the budget for the quarter ending June 1st. Which second quarter is going to include April, May, June. End of the quarter, then we have July, August, which is part of the second quarter. Budget sales for the next 5 months are, in April, we are expect to sell, or we participated to sell 20,000 units. In May, we participated to sell 50,000 units. In June, 30,000 units. That's where the quarter stops. Now we can see how many units we planning to sell in the second quarter, 100,000 units. In July, we plan to sell 25,000 units. And August, we plan to sell 15,000 units. Our selling price per unit is $10. Now that automatically gives us how much is our sales for the April. If we're selling 20,000 units and selling price is $10, our total sales for April will be $200,000. Total sales for May is gonna be $500,000. Total sales for June is gonna be $300,000. So for the second quarter, our sales, projected sales, based on the selling 20,000 in April, 50,000 in May, 30,000 in June, it's gonna be $1 million. In July, if we're selling 25 and cost us $10, that's gonna give us new numbers here. In July, our expected sales gonna be 250,000. That's not plus, that should be time. $10, 250,000, and for August, 150,000. Those are our expected sales. Now for the second quarter only, that's the period for the second quarter. Let's mark it in blue. And for the total for the quarter, let's mark it with green, and that's gonna be for the quarter. And we have our numbers. Great, now let's keep going with these numbers and see how far we can go. Let's make it different than what you have. So if you want, you already have this Excel spreadsheet. If you want, you can adjust it or play with it and do whatever you want. Later, you can use it for your case. So let's go back to slides and see where the slides bring us at this point. Back to slides, and the slide's gonna tell us that if we do that, that's what's gonna happen for the first quarter. Our projected sales are $1 million. Great. Now we have to collect them. In order to collect them, this company, all the sales are on account. The company collection pattern is 70% of the sales for the month are collecting in the month of sales. The next 25% are collected on the following month. 5% are never collected. On March 31st, accounts receivable balance shows the 30,000 outstanding, which will be collected in full, obviously next month, which is the first month of our quarter, which we have to calculate. So now, once we know this, let's move to our Excel spreadsheet, incorporate that information, which is already sitting there for us. So again, the sales are on account, raw collection are 70% collected in the month of sales, 25 collected in the month following month, 5% uncollected. So what we have to do first, let me erase everything so we can start from the beginning. First, we have to see first collection that we're going to do in April. It will be collection for the 30,000. That will be the first money that we're going to get, 30,000. After that, what we have to do is we have to check where are our sales. And as you can see, our sales are right here. So I can bring those cells and paste it right here as a number. So sorry, not the one that I wanted. Maybe I should copy like this, the entire, and paste it right here. Let's see if this is gonna help. Okay, it doesn't let me. Okay, fine. If that's the case, yes, there's some merging and anything, or maybe not, it's not. Let me try this way. Eliminate the Excel spreadsheet. Lately, I find a lot of problem with the Excel spreadsheet. That's my observation. I don't know how you find it, but Microsoft doing very poor job on uh, Excel lately. That's my observation again. I don't want to keep you accountable and you to share my experience. I hope you never share my experience because I'm losing a lot of data lately, and that's not good because probably I have to look for other alternatives rather than Microsoft. Anyway, so those are our sales, quarter by quarter. Now, is everything is going to convert to cash? No. We already know that 5% of 200,000 is going to go away. We're never going to collect them. 5% of $500,000 gone. 5% of $30,000 gone. So how much we're going to collect? 95%. How? Now, first for April, we're going to collect 75% from the month for the sales from April. So my collection for April is going to be 200,000 times the 75%. That shouldn't be percentage, that should be dollar amount. Let's put it like a dollar amount like this. And actually, I'm going to format it. I'm going to format all those cells like this. So in April, I'm going to collect the 30,000 from March, plus I'm going to collect 75% of the sales in April. What's going to happen with the other 25% from the sales in April? The other 25%, I'm going to collect them in May. So the first thing that I'm going to collect in May will be the 25% of the April sales. Plus, I'm going to collect in May the 75% of the sales in May. 500,000 times 75% is going to give me the sales of May, which I'm collecting the 70%. Why I'm putting 75 when they do 70%, right? Then the other 25% from the sales of May, I'm going to collect in June. Plus in June, I'm going to collect the 70% of the sales in June. Times 70%, that's going to give me 210,000. What's going to happen with the other 25? The other 25 I'm going to collect in July. So in July, I'm going to collect the 30%, 300,000 sales of June time the 25, which I'm going to put in the second, 25%. So in July, I'm going to collect 75%. So what that gives me, if for the quarter, what I'm going to collect, I'm going to collect 30,000, then another 140. Those two together, 170, is what I'm going to collect in April. In May, I'm going to collect another 400,000. In June, I'm going to collect another 335,000. And in total, I'm going to collect $905,000. Now, as you can see, the first difference, my quarter sales are $1 million. Do we get $1 million? No, we don't. How much we getting? We're getting 95. How many more we have to collect? 75 more. So from $1 million that we're gonna generate in the second quarter, we're gonna collect exactly 950,000. Why? Because the other 50,000 is gonna be uncollectible. The 30,000 we collecting, that's from the sales from the previous quarter. And that's how we're gonna do the collections. Let's mark this one in this cover. The quarter report will be in green, and we're gonna highlight those numbers so you can see them. And accounts receivables is something that we're gonna use later for our, when we're preparing the balance sheet, we're gonna come back here to see how much is my accounts receivable outstanding at the end of June. And that will be the 25% from the June sales, which will be outstanding and waiting to be collected where in July. Let's go back to the slides. Once we have the collection pattern, we can usually start preparing the collection chart. First, again, we're going to collect the 30,000 for March, and after that, we're going to start collecting the percentages, which we have 70% on the month of sales, 25% the following month. And we keep going, keep going, keep going until we prepare the entire collection schedule. Now the question here is, what will be the total cash collection for the quarter? And we already estimating that one, and we come up with a number that the total calculation for the quarter is $9,500. And justification is, that's another way to do it, for April sales with the showing the calculation. Again, don't forget, accounts receivables are the 25% from the June sales, which will be collected in July. Outstanding accounts receivable this company. Now, the sales budget and expected cash collection budget are done. Now, what we have to do, now we start working, okay, we have the sales. Okay, have the sales. I know how much I'm gonna sell. I'm gonna sell 20,000, 50,000, 30,000 units, which so if I sell those units, I'm gonna have $1 million. From those $1 million, I'm gonna collect $905,000. Now the next question is, if I don't have those products, I cannot sell anything. So what do I have to do? I have to now do my production budget in order to have the inventory, which will match the sales, which I'm anticipating, which is going to bring me the cash that I'm projecting to get. So for the production budget, the company wants the ending inventory every month to be equal to the 20% of the following month budgeted sales. The other thing that we know is on March 31st, we have 4,000 units on hand. So before we continue with the budget, let's think about it. Imagine we are just open coffee shop which sells coffee. We're selling coffee, nothing else, nothing more coffee. No muffins, no cookies, no juices, nothing, just coffee. Pure, simple black coffee. Imagine today we had a very good day and we sold all of our coffee. Is that good for the business? What do you think? We had exceptional demo sales. We sold all the available coffee. Nothing left. Is that good for the business or no? If you say yes, tell me why it's good for the business. Because we know how have no inventory left for coffee. Okay. Tomorrow we opening at 6. Our first client comes. What we gonna tell the client? You know what? I'm sorry, but yesterday we have the best day in our business. We sold all our coffee. Can you please give me your address? And when Costco opens at 8 o'clock, I'm gonna go get the coffee, gonna make you coffee, and gonna bring it to you in your office. What's gonna happen with that client? What do you think gonna happen with that client? He'll go somewhere else. Why? Where? Somewhere that yesterday wasn't that good day for them. And at 6 o'clock in the morning, they actually have coffee. So is it good for us to sell all our coffee if we're a coffee shop? No. Diana, imagine this. Can you just for a second imagine it? Tomorrow morning, you walking in superstore and there's nothing. Absolutely nothing on the shelves. Why? Because today they sold everything. Would you go again in that superstore? So now you understand what I'm talking about. So that's for that reason, everybody projecting that yes, I want to have the units which I'm selling this month, but I also want to have extra inventory, which is gonna help me to start the next month. And you already know from your uh, personal management, from personal budgeting, you never drain your bank account to zero. You're always leaving something, at least the money for the rent for the next month. Why? Because you don't want to worry about when the month ends and the rent is due. At least for that, you don't have to worry. So you always keep in mind that at least I have to have enough money to pay my rent. Same idea with this. So now, once we have this, let's go and do the calculation and to see how we're going to do this calculation. We're going to move to production. Now, for the production, I'm going to push it a little bit down. And I'm going to delete this information here because I want we to get it together rather than you just seeing the information. You can already see it in your Excel spreadsheet. So our starting point is the budget sales. As you remember, we budgeting sales to be 20,000 in April, 50,000 in May, 30,000 in June, total for the quarter 100,000. That's our starting point. How many units we planning to sell? Once we get that numbers, we're gonna incorporate the 20,000 that we need to have as an ending balance. So basically, what we're doing is, if you want to see what exactly it's doing, we're doing on this T account or cost of goods manufactured, if you want, or the raw materials or any account which has a normal balance debit or it's asset account, we're doing simply calculation here for the production. That's what we're doing. So we're getting I'm planning to sell, the sales are the unit that's going to go out from our company. I'm planning to sell 20,000 units. Correct? But I don't want to end up without ending balance. I want to have an ending balance as well. Now I know my beginning balance because the beginning balance is the ending balance from the previous month. The question is how much or how many I need to produce this month. That will be my sales. This will be my production. So this one looks like a finished goods account, correct? So what we have to do is sales. We're going to add the ending balance. So from the formula, beginning balance plus the debit is going to be equal to the credit plus the ending balance. Now our debit is production. Our credit is sales. Beginning balance, ending balance is ending balance. So what we're chasing now? We're chasing the production. So we beginning balance plus production should be equal to the sales plus the ending balance. So my production only should be equal to, when I flip the beginning balance on the other side, it's going to be sales plus ending balance in brackets minus beginning balance. That's exactly what you're doing. That's the exact calculation that we're doing. So we have our sales. Then we try to see what are the desired ending balance that this company wants. They want 20% of the next month sales. So next month sales are 50,000. So I need to have 20%, which is 10,000. But let's put the formula here, 50,000 times 20%. I need to have 10,000. If I get those one, the total that I need is 30,000. I already know that I have from the previous month 4,000. So how many I need to produce? 26 in April. So in order to sell 20,000 units in April, I need to produce 26. That's going to guarantee me the 20,000 sales and guarantee me that I'm going to have 10,000 units available for next month. Okay, let's see May. May, we have the sales. Now we have to add the 20% of the June sales, which is 6,000. So in total, I need 56. But I already have from the previous month, if you remember, we already have 10 because the ending balance for April, we already established is the beginning balance for the May. So I already have those 10,000. So I need to produce in May 46,000. In June, what's going to happen in June now? In June, I need to sell 30, plus I need to have 20% of my July sales now. July sales time 20%. It's going to give me 5,000. Now in total, I need 35,000, but I already have 6,000 from previous month waiting for me. So how many I need to produce? 29,000. Excellent. Now let's see the calculation for the quarter. For the quarter, my sales are $100,000. Sorry, 100,000 units. Now, I have to add the ending inventory at the end of the quarter. Now, when I know that my quarter ends in June, what's the ending balance for my ending inventory for the quarter? Are you guys with me? So, again, I know the quarter ends in June. What is my ending balance for the quarter when I know that the ending month for the quarter is June? What will be my ending balance for the quarter? How am I going to get it? Any guess, any suggestions? Now, having in mind that the quarter ends in June, and the June is the final month for the quarter, at June 30th, the balance that we're going to have is exactly the same balance, $5,000, 5,000 units. So the ending balance for the last month of the quarter is the ending balance for the quarter. So that gives us for the first quarter, we need to have 105,000 units. But I already know that I started the quarter with the beginning balance, which was my ending balance for the first quarter, which was the ending balance on May 31st. How much was that balance? From here, from the question, we can see the balance was 4,000. So my beginning balance for the quarter was $4,000. So this 4,000, it's coming from here. That's the only trick that you have to remember when you're doing the production budget. The ending balance for the quarter is the ending balance for the last month of the quarter. Beginning balance for the quarter is the beginning balance for the first month of the quarter. And then you can easily see that our required production should be 101,000 units. When you combine those three numbers, you're also going to get 101,000 units. Now, if you follow the pattern here, calculating the total, all the horizontal, you're never going to get this number. So you have to be careful. Sales are horizontal calculation. Ending balance for the quarter is the ending balance for the last month of the quarter. That gives you the how much you need to produce. Beginning balance of the quarter is the beginning balance on the first month of the quarter. And when you combine together everything, you're going to get the number of the units that you need to produce in order to sell 100,000 units. And that's our production. Now let's go back to slides. And again, repeat the things. We're getting the sales. Desired ending balance will be 20% of the following month's sales. Ending balance is the number that we have available from the end of March. And then we're going to have the required production for April. Now the question here, what was the required production for May? We can easily switch back to the Excel spreadsheet and see how much is the required production for May. which in our case is $46,000. As we can see, $46,000. And let's go and answer that question. That will be answer B in this case. So what's the required production for May? That will be 46,000 units. Again, the sales plus the desired 20% for the next month sales is going to give you the total minus the ending balance from the previous month, which will be our beginning balance, is going to give us our production. Once we follow the same pattern, we can do it for the entire quarter. Again, remember, sales are total sales. Ending balance for the quarter is the balance for the last month of the quarter. Beginning balance of the quarter is the beginning balance for the first month of the quarter, and then you're getting the totals. Once you prepare the production budget, now we can start using the production budget to start preparing the budget for direct material, direct labor, manufacturing overhead. Let's go with direct material first. For direct material, we need more information. What do we need? How much material we need per 1 unit? Since this is the inventory, we need not to run out of the inventory, so we're going to incorporate some percentage that we need to have at the end of the month. And because now we have to pay for those materials, we can incorporate even cost for the material. And then now we have to prepare the budget for direct material. Let's do that on the Excel spreadsheet again. And in your question, you're going to have the Excel spreadsheet for all those different calculations. So what we're going to start? We're going to start first with the production budget. Production budget will be our leading point. Once we have the production budget, which is right here, I'm going to make some adjustments here. Once I have my production budget, then I can start incorporating the new information, which is related to the material that we have to purchase. First, I know the production for April is 26,000. For May, 46,000. June, 29,000. For the quarter in total, $101,000. For July, my production should be 23,000. How am I going to calculate it? Once I know the sales for August, I know that I need to keep 20% beginning balance, ending balance for July, and 5,000 I have from the previous quarter. That means I have to produce 23,000 in July, and I have my July. So now let's go and calculate it. First thing first, £5 I need for one product. Since I have to produce 26, let's get rid of this calculation and come up with this calculation on this again. £5 for 1 unit. In total, for April to make a April production, I need 130 pounds. For May, I need 230 pounds. For June, I need 145 pounds. In total, I need 505,000 pounds. That's for the material. Now, the next thing that I know is I need to have 10% of the next month material available at the end of the month. So we're going to incorporate that 10%, 230 times 10%. That's going to need 23,000 units. So in total, I need 153. But we already have 13 from March. So we need to purchase 140,000 pounds in April. In May, I have my production pounds. I need 230 pounds of material to produce my 46 products. I also need to have 10% of the next month material available. That's 14,500. That's in total, I need 244,500 pounds. But I already have 23. So I need to purchase May 221,500. For June, I have the pounds that I need to produce for June. Production, I'm gonna add the 10% for my July production to have it available. So in July, when July 1st and when the Canada Day pass, my workers can start have material and start working, continue working until the next delivery comes. Then you're gonna see in the managerial accounting, for those of you who are gonna continue with the managerial accounting, then we're gonna see a reorder point, on which point we're gonna make a new purchase in order to keep the inventory cost low. So once I have that, I need to know how many pounds I have from the previous month, 14,000. So my purchase for the June should be 102,000 pounds. The next thing that I know is I know that cost me 40 pounds, 40 cents per pound. Once I incorporate these 40 cents here, now I can see how much will be my cost every single month and for the quarter in order for me to complete my sales of 100,000 units. Because don't forget, we're preparing all this. We need to produce 101,000 units because our sales for the second quarter is 100,000 units. Now let's do the quarter calculation. We have a gross production that we need in pounds total, we need 505,000. Our ending balance for the quarter is the ending balance for the last month of the quarter, which is June, 11,500. So in total, we need 516,500 pounds of material. But in the beginning of the quarter, we already had 13. So we need to purchase this month for this quarter 503,500 pounds of material. So don't forget the ending balance here, beginning balance here, become beginning balance for the quarter, and the ending balance for the quarter is the ending balance for the last month of the quarter. Let's go back to the slides. Now what we're going to see in the slides is the same calculation, obviously, starting with the production. Then we're going to add the 5 pounds material. We're going to get the production pounds that we need of material to guarantee our production. Then we're going to start calculating the desired ending balance for every each of the months. And the question here will be how much materials we need to purchase in May. And the material that we need to purchase in May, we come up with that calculation. Let's remind each other that will be 221,500 pounds. So that should be answer D. And so 221,500, sorry, answer A in this case. Answer A is the our answer, and once we run the calculation, we're getting 221,500. And once we run everything, we're going to see that for the second quarter, we need in total to purchase 503,500 pounds of material, which materials cost us 40 cents. And the company pay half of the purchase in the month of purchase and the other half next month. Now, on March 31st, we have outstanding payable for 12,000, which we have to pay in April first thing in April, we have to pay the 12,000, which is outstanding for March. So let's go and prepare our payment, direct material payment chart. Now you already have it. I'm gonna run it again so you can see the calculation here. So first thing first, in April, first thing that we're gonna pay is the 12,000 that we owe for March. Those are paid. After that, we're gonna start paying once we have the cost. Now we're gonna start paying the amounts that we need to have for our purchases. So in April, we're gonna pay, that will be 56 times the 50%, which I'm gonna plug right now. That would be 50% here, and 50% here, and 50%, 50%, 50%, and 50%. And that's how much we're gonna pay in April. The rest of the 50% of April, we're gonna pay it in May. 56 times 50%, we're gonna pay it in May. In May, we're also gonna pay 50% for the purchases for May. And the next 50% we're gonna pay then in June. And then in June, we're gonna pay the 50% for June. And the next 50%, that will be equal to this one times 50%. And the next 50% is gonna be our accounts payable at the end, which we have to pay in July. So in total, for the second quarter, we're gonna pay $185,000 for direct material. Let's go back to slides and continue with the slides. So again, we have to prepare the schedule for the payments. First thing that we're gonna pay is the balance from April. Then we're gonna start paying 50-50 April, May. For the April, total cash disbursements, we already calculated $185,000, which coming from the chart. Every month we're paying the 50% from the previous and 50% from the current. 50% from the previous, 50% for the current, and the next 50% from the current month left for July as accounts payable. And we're done with this. Next thing that we have to do is the direct labor. Direct labor, now at this point, once we move from the production budget and direct material, we don't need to worry about the inventory anymore. Why? Because there's no inventory for direct labor. There's no inventory for the manufacturing overhead. So from this point is pretty much downhill. No complex calculation. So let's go with the direct labor. Direct labor, this company, for each unit or each product, they require 0.05 hours or 3 minutes of direct labor. Company has a no layoff policy. So employee will be paid 40 hours per week, regardless of the hours that they work, if they're below 40 hours. So basically, what that means is if the employee work 35 hours, they're going to be paid 40 hours. If they work 37 hours, they're going to be paid 40 hours. What if they work more than 40 hours? If they work more than 40 hours, they'll be not paid overtime, but they're going to be paid exactly the same rate, which they pay. We agreed to pay them $10 per hour, but since we pay them on the short months with 37 below 40 hours, we pay them 40 hours. Then if we require them to work a little bit more than 40 hours, we're going to pay them $10 and there will be no overtime. So for the next 3 months, direct labor force, it will be paying minimum 1,500 hours. So if they work less than 1,500 hours, we're going to pay them 1,500 hours. If they're paying more than that, we're going to pay them $10 as usual hours, not like overtime. Now let's start with our calculation. What do we need? We need the production budget. Because based on the production, we're gonna charge, now to produce our item is gonna take us 0.5 minutes or 0.5 hours, sorry, or 3 minutes to produce those ones. Let me insert some rows here, push everything down and make this one bigger like this. And now I can shrink it a little bit. So we start with the production. If you remember, our production was right here. Unit required to produce, those are the units that we require to produce every month. Let's copy this. Now it's going to tell me that we are not comparable, but we'll try to circumvent this information. So that's our production. From the previous slide. Okay, once we have this, now we start building 0.05 hours. And we're going to see that the total hours that we need, to make our production is 1,300 hours. But we already agree that if the numbers is less than 1,300, we're going to pay them 1,500 hours. And so we're going to pay them in April 1,500 hours. In May, they exceed 1,500, so we're going to pay them purely 2,300 hours. In June, they're below 1,500, we're going to pay them 1,500 hours. So in total, we're going to pay them $53,000. Now there's a question, follow-up question on the slides. Let's do this question, and then we're going to move to the slides. So the question is, what will be the total direct labor cost for the quarter if the company follows the no layoff policy, the same thing, they guarantee 1,500 hours paid, but for every hour above, they paying $15. So what we have to do? We have to see in which month our hour exceed the 15,000. So if you look closely, in April we have 1,500 hours, so we pay them clearly $10. In June we have 2,500, we pay them $10. Only in May we have exceed 1,500. So what that means? We're gonna pay them for the first 1,500 hours. We're gonna pay them $10, and for the excess amount over that, which is 2,300 minus 1,500, that should be $800. For the $800, we're gonna pay them $15 per hour. As we can see here, for the entire amount we pay them, for the entire hours we pay them $10. So basically, and the cost is $53,000. So the additional cost that we're going to have will be only for the 800 hours, additional $5 per hour, which 800 times 5 should be equal to 440. And that will give us 4,000 increase in the cost of the labor. So that we can see here in this calculation that only in May we exceeding the 1,500, we exceeding with 800. So if you apply $10 for all the cost, all the hours, 1,500, that's going to be 45,000. And only for the excess amount of 800 hours, we're going to pay them $15,000 or $12,000. That's going to give us cost of $57,000. So let's go to the slides and complete this at once. So first, again, unit of production. Then we're going to apply the number of the hours that we need to produce one unit. We're going to apply this no layoff policy. We're going to pay them $10 and we're going to get our cost 53. And the next thing was the question. The question asks you if there's a no layoff policy stays, but for every hour above 1,500, we pay them overtime or $15 per hour. What will be the total cost? And only in month of May we have excess over the no layoff hours 1,500. That's 800. For the 800 we owe them $15, and that comes with the cost $57. That concludes direct labor. Now we're moving to the manufacturing overhead. For the manufacturing overhead, what we have to do is we need information. Manufacturing overhead, we're going to split it by two. We're going to have a variable manufacturing overhead, and we're going to have fixed manufacturing overhead. Variable manufacturing overhead will be linked to the direct labor hours, actual hours, not the one that we're paying. And the fixed manufacturing overhead is fixed manufacturing overhead. Depreciation is, since it's part of the overhead, but not part of the cash, it's given us a separate amount, so we can deduct it from our calculation. So let's see what will be our cost for the manufacturing overhead. So once we prepare this, what we're going to get is we're going to get production unit, hours that we need for production. And for every hour that we need, we're going to apply $20 overhead rate. Our variable manufacturing overhead cost for the quarter is right here. The next thing that we have to do is to see how much is the fixed manufacturing overhead. That's our fixed manufacturing overhead. And once we get the fixed manufacturing overhead, then we can calculate the total manufacturing overhead. And the total manufacturing overhead cost is that much. Now, having that cost, that will be expense on the income statement. But since there's a depreciation, we can deduct the depreciation to see the cash, actual cash that we're spending on manufacturing overhead. Once we do this, we're going to see that my total manufacturing overhead, or our total manufacturing overhead, is equal to $251,000. Now our total hours for the period is 5,050. As we can see it here, the total hours for the period. So since this is a budget, or we are on the estimation kind of reality, budget is estimation, we can come up with predetermined manufacturing overhead rate right here, which will be equal to, since we have the total cost and total usage for the allocation base, since we are allocating here, as we can see, we are allocating the manufacturing overhead based on the direct labor hours. Our predetermined manufacturing overhead rate in this case will be 251 divided by 5,050, or $49.70. And that's how we get this predetermined manufacturing overhead. Let's go back to slides. Again, we're going to apply the direct labor hours that we actually going to work. $20 per hour is going to give us the total cost. 50,000, that's the fixed manufacturing overhead. That's not going to change. Total manufacturing overhead cost. Once we have the total manufacturing overhead cost, we can calculate the predetermined manufacturing overhead rate. Then, for the purpose of the future calculation, we're gonna eliminate the depreciation, which is a non-cash item, and we're gonna get the cash disbursement for the manufacturing overhead rate. Once we do that, since we have now direct material cost, direct labor cost, and the manufacturing overhead per unit cost, we can easily come up with the cost per unit. How much is gonna cost her one additional unit? So for direct material, we need 5 pounds, for which pounds we need, are we paying 40 cents? So that's $2. For direct labor, we need 0.05 hours, for which we're paying $10, that's 50 cents. Manufacturing overhead is related to the driver is direct labor. So since we have 0.05 labor hours and we know that manufacturing overhead is 49.70, which we calculated, we're going to apply $2.49. So our product, single product, is going to cost us $4.99. Now the question is, what's our ending finished goods inventory? So where we can find our ending finished goods inventory? Again, cost of goods sold is right here. We have direct material, we have the direct labor, we have the manufacturing overhead, and we have the total unit cost. So now the question is, what's our ending inventory? For the ending inventory, we have to go to our production. And we're going to see that our ending inventory for the end of the quarter in the production was 5,000 units. So 5,000 units times the product cost per unit, it's going to give us total ending inventory, which we can use it for preparation of our balance sheet later. We're going to see how we're going to use it. So if you go back to the slides, let's go back to slides. Any slides, we're going to see that 5,000 units, which coming from the production budget. The total ending inventory on the finished goods is $24,950. Now that concluding the production budget. Now we need to budget for the period cost. Period cost is sales administrative expenses. For the sales administrative expenses, obviously we need more information, which we get in here when we get seeing that sales administrative expenses are always also split by two, variable and fixed cost. Variable cost is directly driven by the units sold, not production. Now we have to go to the units sold. Fixed selling administrative expenses, those are fixed costs per month. In those fixed costs, we have $10,000 depreciation, which is non-cash item, so we have to eliminate it. And if we have to prepare the budget on our Excel spreadsheet, we're gonna go to sales administrative expenses. Let me push a little bit down here. And we're gonna start. Our budget sales, we have it from the sales, the very first sales, 20, 50, 30. 20, 50, 30, in total 100,000. We're paying them 50 cents per unit sold. So our variable expense is $50,000. Fixed administrative, sales administrative expenses are for $210 or $70,000 each month. So the total of sales administrative expenses in our case is $260,000. But in those 260, we have 10,000 per month depreciation, which when we exclude it, our cash for the sales administrative for the period cost is $230,000, which we're going to use later for the cash budget. Once we do this, next thing that we have to do, I have to move to the slides and follow the slides at this point. So we're gonna, once we see this calculation, we're gonna check how much is my cash for the sales and administrative expenses. I believe we already have the number, and that number was, I believe, has 230,000. I just check an Excel spreadsheet. It's 230,000, or answer is B. And once we see the calculation, exactly the calculation that we prepare, or you have as Excel spreadsheet. Once we do with all those budgets, the next thing that we have to do is the cash budget. Now the cash budget, in order to do the cash budget, we need a little bit more information. First, we're going to split the cash budget into 4 sections. First section is going to be cash in and cash in only, excluding borrowing. Only cash from the normal operation of the company or from the customers. Second, will be cash disbursements or any payments related to the business or the principal or interest and anything. But principal interest on the borrowing will be excluded here. But that means that only the cash disbursements which are related to the business. Then we're going to see third part will be calculation, pure calculation, cash in minus cash out. Do we have excess or deficiency? And then we're going to include in the separate section cash if we have to borrow, and cash for the repayment of interest or principal if we have to pay those ones. So for the cash budget, we need a little bit more information, which is that this company maintains 16% open line of credit. So they can go on that line of credit anytime they want. The only thing is they have to pay 16%. They have to maintain minimum cash balance of $30,000. So anytime at the end of the period, they have to have minimum $30,000. For simplicity, they're always going to borrow on the first day of the month, and they're going to repay the loan on the last day of the month. So those 16%, since it's annual, 16 divided by 12, you're going to get the monthly fraction for the interest times the amount outstanding, easy to calculate. This company anticipated to pay cash dividend in April for $49,000. They're also planning to purchase equipment in May for $143,700 and another equipment for $48,300 in June. On April 1st, their cash balance was $40,000. So once we know this, we can start preparing our cash budget. Let's go to Excel spreadsheet again and let's start working on this. Now, as you can sense, the cash budget is going to read from the other budgets. So I'm going to erase everything here. I'm going to start again with you so you can see it. So first thing first, we have to find out how much is our collection. Beginning balance of the cash is 40,000. That's no questions about it. No, that's not for April. This one is 40,000. We got April. Beginning balance. Now, collection for April, we're going to get it from the sales budget. If you remember, on the sales budget here, we did this collection, which is we collect in April $170,000. Now, in May, we're going to collect 400,000, and in June, we're going to collect 335. In total, we're going to collect 905,000. Let's double check. That's 905. The numbers are directly transponded. Now for direct material. Direct material, from direct material schedule, we're gonna go here and we're gonna see the cash that we pay. First, in April, we're gonna pay 40,000. In May, we're gonna pay 72,300, and in June, we're gonna pay 72,700. Let's get those cash for direct material. In total, we're gonna pay 185,000, which is 185,000. Next thing, direct labor. For direct labor, we're paying here. We're gonna pay them $15,000 in April, $23,000 in May, and $15,000 in June. Let's get those numbers. In total, we're gonna pay $53,000 for direct labor, $53,000 for direct labor, right there. Next one, manufacturing overhead. For the manufacturing overhead, our cost is 76, but the cash that we're paying is $20,000 less because of the depreciation. So we're gonna pay 56 in April, 76 in May, and 59 in June. In total, 191. 191 right there, cash, right here, the cash for manufacturing overhead. Next thing that we're gonna do, pay for the sales administrative expenses. Okay, sales administrative expenses were 70,000 in April, 85 in May, and 75 in June. In total, 230,000. So 70, 85, and 75, 230,000. Now, what else are we gonna pay? We're gonna pay dividend, which we already know, 49,000 dividend in April. Then in May, we're gonna purchase 143,700 for the equipment. And in June, we're gonna pay another 48,300 for another equipment. So let's see what's gonna happen for the first month, April. In April, in total, we're gonna collect $210,000 cash. We're gonna spend in total 230,000. So basically, 210 minus 230, we are on deficiency, $20,000. Now, if you remember, we have to keep $30,000 ending balance. So now we need to borrow. We need to borrow 20,000 to bring to balance to zero, and another 30 to bring the balance to 30. So that means in total we need to borrow 50,000. $50,000. If we borrow $50,000, my ending balance is gonna be end up with 30,000, which is my objective. Remember, 50, which I'm borrowing, minus plus the deficiency 20 is gonna give me 30,000 right there. So I have the 30,000. Excellent. So now let's keep going. Beginning balance for the May will be ending balance for April, which is 30,000. In May, once I have the 30,000 beginning plus the 400 that I'm gonna collect, total cash will be 430. Once I get all my disbursements, those will be $400,000. So in this case, I'm gonna have 430 minus 400,000. I'm gonna have exactly $30,000 cash, which is exactly what I needed. So I don't need to borrow. I don't need to, I cannot repay because I don't have cash, obviously. I have exactly $30,000. So the ending cash will be the 30,000 plus the zero. That will be, let's see, where do we need to split this one? I don't need to split it. I need to go with some here. It's going to be close. Sales and 30,000. June, 30,000 for May is going to become beginning balance for June. 30,000. So I'm going to collect 335. In total, I'm going to have $365,000 cash. The cash I'm going to spend in June is $270,000. So that's going to give me excess of $95,000. So now the question is, do I have enough cash to pay my borrowing and still be over 30,000? 95 minus 50 is going to give me 45. I need 30. I'm still $15,000 more. So let's pay this one. I'm going to pay 50,000 for the loan. Now, since I'm paying for the loan, I have to pay for the interest, right? And I borrow on the first day of April and I'm paying the last day of June. So I have the loan for 3 months. So the calculation here will be equal to negative bracket 3 divided by 12 bracket times 0.16, 16% times $50,000, which is my borrowing. And I need to put one more bracket here. So in total interest that I have to pay is $2,000. So my total payment here will be $52,000. Means that the cash that I'm going to end up with, 95 plus the 52, is going to be 43,000, which is above 30,000. So I'm safe. So that's how you prepare the cash budget. Again, it has two sections. One is the total cash received. The other one is the total disbursements paid. Then we're going to have the cash excess or deficiency. And then we're going to see if we have to borrow or we can invest somewhere. And after that, we're going to see the ending cash balance. And that's how we prepare the cash budget. Now let's go to slides. Again, we're going to start with the collection. Then we're going to add direct material, direct labor, manufacturing overhead, selling administrative expenses plus the dividend that we pay. We're going to see the total disbursements. We're going to see how we have excess or deficiency and how much we need to borrow. And we keep going in May again. Cash receipts plus direct material, direct labor, manufacturing overhead, selling administrative expenses, equipment purchase, how much we have, and keep going. So what's the excess deficiency in cash available over the disbursements in June? We already calculate that one. That was $95,000. So that's the justification, $95,000, which is enough to pay the loan that we borrow in the beginning of April, pay the interest, and we have $43,000 cash available. Once we're done with the cash flow budget, then we can move to the financial statements, which is the income statement and the balance sheet. For the income statement, how are we going to get the income statement? Well, that will be not so hard if we can think for a second. For the income statement, what do we need? We need sales. From the sales budget, I can grab my sales. My total sales, I already know, is $1 million. Why? Because I'm selling 100,000 units at $10. So my sales are $1 million. How much is my cost of goods sold? Well, I already know that I'm selling 100,000 units. And I already know that one unit costs me $4.99. That give me cost of goods sold as 499,000. Contribution margin, first calculation. Contribution margin is $5,100. Then I have operating expenses, which operating expenses now are only and only sales administrative expenses. Since I have direct material, direct labor, manufacturing overhead all together into the cost of goods sold. Once I get the operating expenses, which is 260,000 from sales administrative expenses, I can see that net income before the interest is $241,000. Once I deduct the interest, $2,000 interest that we paid for the borrowing of $50,000, our net income is $239,000. Once we have the budget income statement, then we can prepare the budget balance sheet. Budget balance sheet, for the budget balance sheet, we're gonna need a little bit more information though. And that information will be, I'm gonna erase those numbers. So you can see how we can get those numbers. First, we're gonna have land, 50,000. And we're gonna have equipment and 175. I'm purposely gonna put it here. You see in the second way. Common shares, we have 200,000 common shares. And retained earnings. For the retained earnings, I have to do separate calculation here. So I can either do the calculation, either open the T account. Let's open T account so you can see the retained earnings, how exactly works. As we know about the retained earnings, since is part of the equity, normal balance is credit. If there's beginning balance, that's on the credit side. I don't need I can use this one like this. So beginning balance gonna be here. Ending balance gonna be on the credit side. That's my debit. That's my credit. And what else I know for the retained earnings? I already know what's coming in the retained earnings and what's going out from the retained earnings. Coming in is the net income. And going out is the dividend. I have the beginning balance of the retained earnings, 146, 150. The next thing is I just have to calculate to see what exactly happens in this retained earnings. So let's go one after another. Cash. From where we're going to get the cash? Cash, we're going to get it from the cash budget. From the cash budget, we already know that at the end we have $43,000. Accounts receivables. If you remember, when we're calculating the sales and we're calculating the collections, we already determined that the amount of cash that we're going to receive in July, let's put it this way, the amount of cash that we haven't collected and sitting outstanding at the end of June is equal to 25% of the June sales, which is 75, which we're going to collect in July. So that's the 75 that we have. The raw material. Raw material inventory, we have to go to the direct material and see how much raw materials we have at the end of the period. And we see that we have 11,500 pounds of material, which cost us 40 cents. And those two is going to give us the raw material inventory available at the end of the quarter. Finished goods inventory, we already calculated. Either we can get it from here, 24,950. Either we can get it from the direct material, from the purchases in this case, 5,000 times the cost of goods sold, which is for those 99 cents. Long-term assets. We have $50,000 land. We haven't purchased any land, but we purchased two equipments, as you can see. So on the balance sheet, what we're gonna have? We're gonna have the 175,000 plus from cash. We purchased 143,700 plus we purchase now 48,300. So total equipment that we have now is $367,000. 367,123. And now I can delete this number because I don't. So my total assets are 564,550. Now magically I have to come up with the same number. Let's see if that's going to happen. Accounts payable from the direct material. We already saw that we still have to pay at the end of the quarter. We still have to pay for the 50% of the June material that we purchase, which is 28,400, which we're going to be paid in July. So that's our outstanding accounts payable. The debt, $5,000 borrowing, we already repaid, so there's nothing there. The last thing that left is the retained earnings. Now we have the beginning balance, 146,000, 150. Net income, we already calculate our net income is $239. We already know that we paid dividends, and the dividend that we paid was 49,000. So we get that 49,000. Let me format this one and flip it right here. So the last thing left is to get my ending balance. Ending balance is going to be the beginning balance plus the credit minus the debit. So my ending balance for the retainer is going to be 336,150. So if I plug this number here, I should be in balance. And as you can see, magically, we are in balance. So we did balance sheet, budget for the balance sheet. Let's go back to the slides and now complete the slides. First, again, with the income statement. Income statement, again, sales minus cost of goods sold, which we already know. It's going to give us the gross margin minus sales administrative expenses, which we have it from the sales administrative expense budget. It's going to give us the operating income. Deducting the interest that we pay 2,000 for the borrowing of 5,000, it's going to give us the net income for the period. For the balance sheet, again, we need information for the long-term assets, capital, and the retained earnings. And once we do this calculation and plug all the numbers, we're going to get the budgeted balance sheet, which total assets is 564,550, and the total liability is exactly the same amount. The only thing that you have to do extra is that retained earnings, having in mind that the formula that I show you, the T account or here the formula, what we're going to get? We're going to get beginning balance, we're going to add the net income, we're going to deduct the dividend, and we're going to get the ending balance. Those are some extra calculations for you. So you can see the extra calculation if you want, and how those budgets are prepared, different sets of budgets. The important part is what we did so far. We did a perfect calculation which exists only and only in one reality, which is only and only if you achieve the sales which we set in the beginning, only and only in that case we're going to get that cash flow that we prepare, that income statement that we prepare, and that balance sheet that we prepare. If the sales change with one unit, all this budget It's gone. Now, this budget is called static budget. Why? Because it's prepared for the level of activity which is predetermined at that stage of the preparation of the budget. Only and only if you achieve those sales, then we're gonna prepare this. But we need this production, we need this direct material, we need that much direct labor, we need that manufacturing overhead, we need that sales administrative expenses, and keep going, keep going. Now, that's not going to help us because that's going to help us to see the numbers. But if we start comparing budget with the actual activity, then we won't be able to draw any conclusions. For that reason, we need to prepare flexible budget. Now, the flexible budget, pay attention here because the flexible budget, I'm going to ask you to do it on the final exam. Now, for the flexible budget, to prepare it, what we need to know is how the costs behave. And again, the costs behave in two ways, as a variable and a fixed. So let's see. Let's run one performance report based on the static budget only. If this company projecting to use 10,000 machine hours, they're projecting to have the indirect labor $40,000, indirect material $30,000, power $5,000, which is the variable cost, fixed cost, depreciation, insurance 12 and 2,000 respectively. In reality, machine hours were less. Well, obviously, if the machine hours are less, we're going to have less indirect labor, less indirect material, less power. The fixed cost is going to stay the same because it's a fixed cost. And once we run the variances, we're going to see that machine hours, because we're losing the machine less hours, which is unfavorable now for what we projected, all the costs are now favorable. Why? Because looks like we're saving on costs. The question is that actually true? Looks like at this point that we're saving 11,650. But the only reason why the cost is low at this point that we can clearly see is because we're using the machine less hours. Are we overspending or not spending on any of those costs? We are not able to say. Why? Because those costs are different in reality. This 40,000 happen only and only we have 10,000 hours, machine hours. And this 34 happen because we have 8,000 hours. If now, in order to compare those numbers, we have to prepare the budget, which give us projection, what will be our cost if we use the machine for 8,000 hours? And then compare with the actual results and see, do we have variance or not? So, again, question is, since the cost variance is favorable, do we did a good job? The answer is we cannot say. Why? Because the only thing that we can say is we using the machine less hours. Because of that, we having less cost. Is it favorable? Is it not favorable? We cannot say. We have to prepare the flexible budget. How are we going to do that? Again, we're going to remind ourselves how the costs behave. Costs behave as a variable and as a fix. Total fixed cost never changes. Variable cost per unit never changes. Total variable cost always goes up. Fixed cost per unit always goes down. Now, knowing that, now we can prepare the flexible budget. How? Well, very simple. I already know how much is my total variable cost when I have 10,000 hours. What will be the indirect labor cost per 1 hour, knowing that total is 40,000 when I'm using 10 machine hours? Obviously, will be $4. Indirect material, per one machine hour. Since I'm having $30,000 for 10,000 hours, that's going to be $3 per hour. Power, $5,000 when I'm using the machine 10,000 hours, that means 50 cents. Fixed cost is fixed cost. Well, that's not going to change. So now, knowing that and knowing what's the variable cost per unit, now I can prepare different budgets for 8,000 hours, for 10,000 hours, for 12,000 hours. And once I run this cost, I'm going to have those different units, different budgets now. And for 12,000, obviously we're going to come up with the cost, and that's 104,000. Okay, great. But now I have this budget, which is for 8,000 hours, which happen to be exactly the 8,000 hours that I'm actually using the machine. So let's see now, when I actually using the machine in the process, when the actual results coming, when I'm using the machine 8 hours, our actual spending is $34,000. Based on our budget, we're supposed to spend $32,000. Now the question is, are we overspending or underspending? In this case, we can clearly see that we overspending $2,000, which $2,000 transferred to be unfavorable for us. That's for the only for the indirect labor. Let's see indirect material. Our actual cost is $25,500, but on our budget for 8,000 hours, we're supposed to spend $24,000. In reality, we're spending $25,500. So are we overspending or underspending in this case? Obviously, we overspending. How much? $1,500, which is unfavorable again for us. For the power, we're spending 3,800 when we're using 8,000 machine for 8,000 machine hours. Based on our budget, we're supposed to spend for 8,000 hours, we're supposed to spend $4,000. So in this case, if we actually spend 3,800, are we overspending or underspending? Obviously, in this case, we underspending. How much? $200, which transferred to us to be favorable variance. So when we run this report, we're going to see for the variance for the indirect labor, we overspending 2,000. That's 2,000 unfavorable for us. And when we run, we're going to see 2,000 unfavorable. For the next one, which is the indirect material, we overspending 1,500, which is 25,500 minus 24,000. That's overspending 1,500. On the fixed cost, depreciation stays the same, but the insurance goes up with $50. So in reality, we overspending $3,350, which brings everything to unfavorable variance. So now you can see when we comparing 10,000 machine hours versus 8,000 machine hours, but 8,000 machine hours budget with the 8,000 actual results, we're seeing the favorable or spend less cost. But when we adjust the budget to the actual results, we're seeing that we're overspending. We're supposed to spend in total $74,000. We're spending $77,350. So how can we interpret these numbers? Well, the difference between the original static budget and actual overhead is 11,600 favorable. But that only gives us the difference between the $10,000 machine hours and the $8,000 actual usage of the machine. That doesn't explain are we overspending or underspending. Once we prepare the flexible budget, which matching the actual hours, for the cost control, now we can use the flexible budget for the activity, actual level of activity, and we to start analyzing, do we have favorable variance or unfavorable variance? Next time in next chapter, we're going to start looking closely of those variances and how we to prepare variance analysis reports. Last thing that I wanted to tell you for today is how we can use the budget for the non-for-profit enterprises. Can we use it? Absolutely. Can we use it for your family? Absolutely. Can we use it for our anything? You can use it everywhere. You can see a lot of examples. Just turn on the TV, and you can see at least two reality shows that dealing with the couple that overspending. They cannot control their spendings. Why? Because they have no idea where they're spending, how much they're spending, and from where the money coming and where the money going. Why? Because they don't have a goal. Again, everything is going to make sense if you have a goal. Once you have a goal, once you set yourself a objective, then you can start prepare the plan. One of the plan is how you're going to acquire and how you're going to spend resources, which can be financial and non-financial resources. But again, the point is, do you have a goal? If you have a goal, you can do the planning. You can use the budget to bring you close to the goal. And once you have to compare the actual with the budget, you can see how much you're deviating from your plan, and do you need to catch up or do you need to slow down? What exactly you have to do. Inventory decisions, we're not going to spend on the inventory decisions. That will be for the inventory decisions. Obviously, that's interesting thing, but not part of this course. That will be for the people who are going to go with the intermediate managerial accounting. For those of you who are not going, that's something additional. If you want, spend a little bit time, but there's no formulas here, nothing. Just pure information. Again, not examinable. You don't have to worry about this. That will be all for the budget, people. As you can see, budget is very interesting. It can be drawn very many conclusions. Be careful when you're drawing conclusions based on the budgets. Prepare for one level of activity and actual results in different level of activity. You may go and draw conclusion which has nothing to do with the reality. You have to compare apple to apple. If it's not apple to apple, you have to move the static budget into the flexible budget and then run the comparison again. And then you can see the actual overspending or underspending by preparing this static budget, and you're going to see actual results. So be very careful with comparison between the budget and the actual results, especially when the budget is prepared only for one level of activity. That's why in the managerial accounting, what we're going to do is what people usually doing. We're not going to do it here, but we're doing the budget for one level of activity and then showing the incremental. If this happen, what's going to happen? If this happen, what's going to happen? If this happen, what's going to happen? Different scenarios. You can go with the best case scenario. We can go with the worst case scenario. We can go with the a little bit more risky scenario. Any different scenarios, and you can see what's going to happen. And when you actual results happen, you're going to have difference, and now you can compare one with another. And there are always going to be differences. In very, very, very rare cases, you're going to achieve exactly what you're planning, unless you're planning very closely. And if you want to get good at the planning stage, you have to do the planning often. More often you're doing, better you're gonna get. If you more mistakes you're making, better you're gonna get. So the question will be, when you're gonna become free of mistakes? And only you can become free of mistakes when you pass through all the mistakes that you have to pass in order to learn something. That will be the key here. So make as many mistakes as possible here in the classroom on when you're doing the budget. And once you start preparing the calculation for the case, more you see me, less mistakes you're gonna make. I mean, ideally you can get it right away in the first place. That's what I expect you to do since you have all the information available, plus me going over these calculations 2 times today. One I show you on the Excel spreadsheet, second time I show you on the slides. So we did the same calculation 2 times today. And if you go over the calculation by yourself, that will be third time. And then when you have to do the case, that's going to be the fourth time. Yes, you may make some mistakes, but I expect you to make mistakes so you can learn. That's the point of the mistakes, you to learn. Questions? Any questions?